It doesn't make sense. Seriously. This is what our clients think. And I think this is what you're thinking when you try to buy a home and you start talking to mortgage lenders and real estate agents and the people involved, because we use a lot of words that you don't see every day. And although we may use these terms all the time, that doesn't make it any easier for you. This is part 3 of trying to simplify all the complicated things we talk about when you're looking to buy a home. So in the last 2 videos, we talked about different parts of the process when you're submitting an offer, getting pre-approved, once you go under contract. There were some terms that were left out. So in this video, I'm going to cover just some of the terms here and there that we didn't exactly go over that I think are still words that you probably want to know about. And I'm going to start with one of the most obvious that I think are the most obvious. Therefore, I know I'm wrong because I'm a lender, right? So I think you know. But we're going to start with the term equity. Equity simply is the amount that you have, the value of your home, the difference between what you owe on a loan versus the actual value of that property. So if you had a $300,000 home, you owe $100,000 on that mortgage, you have $200,000 in equity. So you'll hear that termed a lot. Americans have never had more equity in their home. Well, what does that mean? It basically means what's the value above what you owe on your home. HOA. So HOA is a homeowners association. And this is common with condominiums or townhomes, but basically this is like a management company. When you buy a condo or you buy into an organization where there's other owners who are part of the same grounds, well, you're basically going into business with the other owners. That business is managed by an association or the HOA. So when you hear about HOA dues, these are the fees that you pay for their services or for other items like your insurance on the property, like the structure of a whole. If you're buying a condo, there's an insurance policy for the entire building, or there'll be like water and trash. Because keep in mind, if you're part of this one structure, you can't just pay the water that comes into your unit, right? It goes into the whole building. So the HOA is the Homeowners Association, and HOA dues are the fees you pay for the management of that, as well as some of those amenities that go into it. So how about that? Amenities, right? It's not necessarily just for real estate, but what is it? Amenities are basically factors, extras that you get, right? If you want to go through and you buy a property and you're buying into a condo, what are the amenities? Well, it could be, is there a gym? Is there a dry cleaner? Is there a doorman? These are things outside of just your common ownership of that property and the extras that you get. So when you're talking about what the amenities are, you're talking about what am I really getting for my money, I guess, right? That's one way to put it. Another word, I covered this briefly in the last account, but I want to bring it back, is escrow account. So an escrow account is an account that's managed by your lender that will be used to pay your property taxes and your homeowner's insurance. Sometimes just your taxes, never just your insurance. But it's an account that will manage basically those bills for you. When you make your monthly mortgage payment, you'll pay into this account, and then when those bills come out and they're due, then you'll receive a copy of that bill. The lender will receive a copy of that bill, and the escrow account will disperse payment on those accounts. Now, keep in mind, you may hear escrow used differently depending on where you're at in the country. Escrow can also refer to when you go under contract on a property. It's common in states like California where someone will say, oh, we're in escrow. Well, that just means that you've made an offer on a property, the seller's accepted your offer, and now that's been put into the legal transaction where you're moving forward. So if you ever hear someone saying close of escrow or we're in escrow, don't confuse that with a tax escrow account. So I thought maybe it was good to simplify that. I wanted to talk about PMI. You hear this all the time. PMI is an acronym for private mortgage insurance, okay? So if you put less than 20% down on a conventional loan, you have to insure the difference in your down payment and that 20%. For example, if you put down, you're buying a home and you put down 5%, well, you have to insure the other 15%, bridging that gap to make that 20%. So you're insuring the bank, you insure the lender. Private mortgage insurance is a policy issued by a private company to insure the lender so that if you don't pay the loan, then the lender will be able to recover some of those expenses and those costs. So when you hear someone talk about mortgage insurance or PMI, that's private mortgage insurance. And just keep in mind, it's a private company that the lender selects that will then issue this policy that's required when you put less than 20% down. Adjustable rate mortgage. Let's stay with the acronyms, otherwise known as an ARM. Okay, so ARM stands for adjustable rate mortgage. These are traditionally and almost always going to be a 30-year loan. And unlike a 30-year fixed, an adjustable rate mortgage is only fixed for a set period of time. For example, if you use a 7-year ARM, 7-year adjustable rate mortgage, then that means that loan's only fixed for 7 years. After that time frame, that rate can continue to adjust based off of the agreement at closing. And this is usually based off what we call a margin plus an index, but that's a whole other set of confusing terms that we're not going to get into today. So when you talk about adjustable rate mortgages, you're talking about a 30-year loan that will only be fixed for a set period of time. And some people like to use these loans if they know they're going to be short term in that property. Maybe you're relocating or something of that nature, but that's for your conversation with your lender. PITI, I think, is something you may hear. When people say your PITI, stands for principal, interest, taxes, insurance. It's a really fancy way of saying your monthly payment. Now keep in mind, if you don't escrow, going back to that term, if you don't have an escrow account, then you're only paying principal and interest with your mortgage payment. But otherwise, you're paying, if you do have an escrow account, you're paying principal, you're paying interest, and then your portion of your taxes and your insurance. So when you hear someone talk about your PITI or your PITI, that's what they're talking about. It's no wonder that it's so hard to buy a home. It's bad enough that you have to find a place, you've got to go through and qualify for a loan, but then on top of that, you have to talk to people like me who use terms that make it very difficult. This was our third video talking about these terms that are used frequently, where we assume you know what we're talking about, but I've come to realize that may not be the case. I hope you find this helpful. Remember to check out the other 2 videos if you didn't have a chance, but otherwise, like, subscribe, and pay attention for more videos we have to try and make buying a home easier.